You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, well, we'll do a quick recap of Nexstar Media Group, our fig leaf from last week. Symbol was NXTR because it was not a well-known stock. At least most people probably don't have the symbol memorized. We did a fig leaf, and I talked about a source being a little bullish on it. We figured it was over $100 stock, so we thought it would be a good underlying to do a fig leaf on. We talked a lot about the reasons why. Not necessarily meant to be a recommendation, as everything on Options Playbook Radio. We're just trying to learn. And the stock actually has ran up. It's ran up more than probably expected, and it's hitting an all-time high today. The stock is at 109.28. We went out into the 2020 year and bought a 90 strike call option deep in the money, had about an 80 delta. And then we sold the 110 with the April 18th expiration. So the reason why I bring this up is, if this were a live position, if we, as a matter of fact, we're paper trading it, if it were a live position, you're at a point now where you have to do something. The stock is at 109.28. I'd rather have it be there than 110.28, if you will, and let it be in the money. So you're almost at the money on the short-term option. And as I mentioned last week, the reason why we call it a fig leaf is because we say you're kind of covered. That's the tagline that goes with it. And the rationale behind that is, and the naming of the strategy, otherwise known as a leverage covered call, is that you're buying a deep in the money option as a surrogate for the stock. The deep in the money option is an 80 delta option. At least that's where we were last week. I think it was 79 to be exact. And it represents a lot of the stock price movement. You can think of it as it represents 80% of the stock price movement for a lot lower cost than the actual stock. But you don't own the shares of stock. So if this stock starts running in the money, you're going to have to do something, and you just have this longer-term option. So at this stage, either it's been a 5-point run-up on the underlying stock. It's, like I said, it looks like a new 52-week high today. It hit at some point in time. And the simple thing to do would be to just close out the entire trade. Now, you didn't do as well as if you just bought the option outright, but you were positive, net positive delta, and you should have a fairly decent profit on the trade after a 5-point move. Now, to the upside in the direction that you wanted it to go. Now, the other alternative is to roll that position, which basically means we're going to buy to close the April 18th expiration, 110 strike call, and then you want to go either up in strike and out in time, or you just want to go out in time. You just want to try to prevent from being assigned on that short-term option. Because if you're assigned, then you're going to have to do some dancing. You want to sell your leap option contract and get as much time value out of it as possible. And then you would actually buy the stock and let that stock get called away from you. So since we made the run up a little bit too fast, actually, in our scenario, which that's all right. It went in our directions. We're doing well. The next thing that you want to do then is go out and look at what a potential roll might be. So I'm going to go into the Ally Invest option chains, and I'm going to look at all the option contracts that are out here. And here's the biggest thing, the lesson to be learned about this is you need to act fast. If an option contract is getting in the money or coming very close, that's when you want to roll. You don't want to roll when it's 5 or 10 points in the money because there's no time premium to mess with, right? The time premium is the reason why you can roll. And it all is centered around the at-the-money option contract. That's where all the juice is in general. So in this instance, our April 18th expiration, we could go in and buy to close the 110 call option. And now the downside is we got to go all the way out to May because there are no weekly option contracts. So our next available option is 51 days out. But because we're going so much further out in time, we can actually go another 5 points higher. So we would be buying to close the 110 with the 22 days remaining, April 18th expiration, and then selling to open the 115 going out to the May 17th expiration, which is 51 days away. So now we can do this entire trade for a small net credit to the account of about 20 cents. So we need to act fast if we want to do this, right? Because it's not a big net credit, but we're giving ourselves 5 more points of upside. And there is a section in the options playbook titled How We Roll, and it deals with the rolling of cash secured puts and covered calls. So in this instance, we're not talking about a full-blown covered call. We got a fig leaf on, but it's even more imperative that you understand when you want to roll and how to roll in order to do that trade. So we'll leave it at that. We'll just say that the stock has moved up, and it's weird because the day that we're taping Options Playbook Radio, it is, by the way, I should mention that, it is March 27th. It's a Wednesday. The markets are closed, and it just hit that all-time high. It almost got up to the 110 level, which is our short strike. It didn't actually touch that yet today at all, but it came very close. So time to roll. And hence the roll that we would probably look at is going up and out in strike. So closing the short-term April expiration at the 110 strike, opening the May 17th longer-term expiration at the 115 strike, and bringing in a small net credit in the account to do that. All right. Now let's get into today's trade. We usually like to talk about stocks in the news here on Options Playbook Radio. And last week we kind of did a little bit more of a no-name stock. So let's talk about Boeing, the big one that's in the news today. They came out and had, I guess you could call it positive news in that they think they got a software fix for their planes, the 737, the new ones that are out there. And so the stock has made a little bit of a run up. Now, one of the problems with Boeing is that as far as an equity trader is concerned, it's a $374 stock. So it's a fairly expensive stock. So options are always attractive when we're in that realm. So I think we're going to look at an out of the money long call spread today because there's so much premium that's in these option contracts that we haven't talked a lot about long call spreads inside the options playbook. So I think that's a fairly decent opportunity. And once again, I don't care necessarily what your opinion is on Boeing. We're going to go to the bull side just because we usually look at one trade. But you can flip this around and you can go to the bear side and you would be doing a bear put spread, which means it's also a put debit spread. But today our paper trade, we're going to go out about 17 days And we're going to go out of the money on this underlying. Now, that means that we got to be fairly bullish to do this, but we definitely don't want to just go out of the money and buy option contracts because the volatility is fairly high. The fact that we're dealing with a $375 stock, that also adds premium to the price of the call options. But this would be a little bit, we're going to have a nice risk reward on it, but we do need a big move in the underlying stock. So we're going to go out to the April 12th expiration, and we're looking to buy the 390 strike call and at the same time sell the 400 strike call. It's a 10-point wide spread. We're looking at doing this for a net debit of $2.10 to the account, or $210 plus commission. That would be the maximum risk on the trade. And the maximum upside would be the width of the spread, which is 10 points, minus that $2.10, or $7.90. If we do this trade, we want the stock to finish above 100 by that April 12th expiration date. So with Boeing, the April 12th expiration date is 16 days away. And one of the things that we're looking at when we're doing spreads is you can go out farther in time. 16 days is looking for a fairly big pop in the underlying stock over that time period, but you can go out farther in time on it. But you want to think about the timing of long call spreads. You would prefer that it got to the 400 closer to expiration than right away. So you're looking for about a 25-point move overall on a $375 stock. So you're looking at about a 6% move. So even though 25 points seems like a lot, overall it's about 6%. Boeing was actually at around 420 when the news hit about the second plane crash with similar circumstances. So our goal here on Options Playbook Radio is to try to talk about all the different strategies that are available and look for different scenarios when it might happen. But if you're buying Boeing and you want to get bullish on it, we're definitely not going to be just buying options outright. A long call spread, otherwise known as a bull call spread or a call debit spread, is a much better solution than just buying it outright because of the total premium and the access to time decay. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.